I'll start with you. What does it mean for the markets when you see comments like this from Trump?
You mean whether Powell's blocked Trump on his Twitter feed?
Let's call for zero rates or even less.
Well, I think Powell's going to do his darndest to just sort of ignore all that stuff. He's said that publicly several times, and he has to. I think the question really gets down to, look, the gulf between what the rates market is telling us and what equity and credit on the other are telling us is still very wide. It got a little close the last couple of weeks, but what's going to happen next week after the FOMC is inherently a volatility event one way or the other, whether it drives more sector rotation or whether it drives risk assets broadly downward is to be seen here. But I think it's whether Powell's going to, but my expectation is that it'll give us 25 with a less dovish message than a lot of people think he will. The data is not supporting a lot of cuts right now. The City Surprise Index for inflation and the economy in the U.S. has been moving steadily higher for 3 months straight.
Ed, do you agree with that?
Yeah, absolutely. I think that's dead on right. The economy is actually doing quite fine. The Friday payroll employment number seemed a little bit weak, but I think every other indicator for the labor market shows that there's plenty of jobs. As a matter of fact, more and more businesses are saying that they just can't find people to hire. So there's actually a labor shortage out there. And so all in all, the economy is continuing to grow around 2%, which is what it's been doing since about 2010. So I don't really see much of a need for more than 25 basis points at this next meeting, and then a long pause would probably be in order.
And Ed, I'm looking at this note from you from last week from FOMO, fear of missing out, to phonier, fear of negative interest rates. You say that this is your note from last week, from phono to phonier. Can you hear me? Okay. Michael, taking a look at the markets right now, I mean, Dow's up 23 points. We're basically hugging the flat line. But in general, one of the big focuses this week has been this idea of rotation out of growth into value. How do you think about that? Is it sustainable, and are you positioning yourself accordingly?
I think if you look at the correlations of, say, the Russell 2000 relative to the SPX versus the 10-year yield, or you look at tech versus financials, that equity pair relative to the 10-year yield, or the Russell growth to Russell value, that pair ratio relative to the 10-year yield, it's all the exact same trade. It's basically right now a trade, not necessarily a longer-term thesis on rates going higher. Rates got so low, so aggressively. I think when you step back for a second, look, you look at the risk assets, SPX up 16% year to date. Within that rally, there's been massive polarization, right? Utilities bid to record levels relative to the SPX. Banks bid to record levels the other way, right? So, and at the backdrop, of course, is this massive contraction in rates. So if rates are going to be going the other way, the unwind is very powerful here. And I think you have, even if you're a longer-term investor, you have to take stock of that.